This is going to be a storm of data, information across the board. And what you will see is basically I'm saying, what is it that I see that maybe others don't? So I'm talking quickly on CVC, the dry powder, investments, exit returns, and then the internationalization of startups. There's some totally new stuff that I'm happy to share with you. So on the corporate side, the rise and role of Asia, you've just heard from the panelists. The one thing I want to make sure is when we talk about innovation, when I came to Asia 20 years ago and looked at innovation, it was mainly a business model innovation. In the Western world, it was predominantly product innovation, technology innovation, simply because it's measurable, publication and patents, while process innovation, business model innovation is hard to measure. And then we looked at, I can give you a preview, not released it from Stanford, is we looked at top 3 sector leaders that have emerged. And interestingly enough, on the ones that became top 3 sector leaders were the ones which had 3 of the 4 innovation areas. In any of them, doesn't matter, but every single one included a business model innovation, every single one. So this is something the Western world, this was a view on the Western world. It did not include Asia research portfolios on this. The corporates, historically, they have been looking closer to the bottom left-hand corner, which was like short-term improved products. And I see this in emerging markets happening. In every new market, the corporates who start locally, they focus on improving. But as the industry matures, as the corporates mature, they all go up basically to the right-hand corner, right? Which is really in breakaway, brand new areas which they haven't been in. It does take longer, it's a higher risk, and Asia is still very short-term focused, but I can see now this heading on. You don't need to be able to read this. I've been looking at comparing the top 20 US R&D spenders and the top 20 Chinese as a comparison. And in a summary, I can tell you is, it still, by coincidence, happened to be number 1 in the US, was Exxon in 2018 because they did a massive new wave. Otherwise, they're way back. But the pharmaceutical companies in the US, they put up 20, 25, 30% plus of their net revenue into R&D, which is unheard of. You don't see this in Asia. You don't see this in China. So if I say Huawei is a big exception at about 14%, ZTE at about 13%, in Alibaba, number 2 in terms of dollars, RMBs invested, in comparison, it's all RMB based here, ranks about number 18 in the US in terms of absolute dollars invested. And you look at, so that is roughly giving you an idea. So the Chinese have not yet reached the level of percentages putting into R&D from their revenues. And that is something they need to catch up. Talking about corporate venturing, in 2016, you had about 66% of the Fortune 100 not investing. And now you are at 77% who do invest of the Fortune 100 in the US. But equally important is 52% have a corporate venture unit. So when I say corporate venturing, it means activities, either a venture fund, the corporate venture teams, or accelerators, incubators. So that is what the term corporate venturing is. And corporate venture capital is just the unit or the team or the amount that they invest. Something else which is different or which is important, which has changed the last 5 years dramatically, and I'm doing research on this for about 20 years now, is you can see at the bottom that CVC rounds only, so these are corporate VCs that invest from a corporate perspective, in combination with a balance sheet investment or an independent investment from the corporate entity. So you have, keep this in mind, there are two things. You have a corporate VC team which invests, but sometimes strategically you have a corporate direct investment independent from the team. And the bottom one is the combination of both. So the corporate has added on top to the VC investment because it's very, very strategic for them. The middle one, which is only corporate VC rounds, 2,177, that means these are only the venture team investing into deals. And what struck me is the large strategic volume in terms of number of deals which corporates invest independently. Now, what does that mean? So we looked at the data. The 3,820 deals has to do with many of them only doing one deal or two deals. They don't have even a corporate VC team, but it's strategic and they still want to go into the deal. So this is what I'm trying to say about corporate venture only as a strategic investment, which has overtaken in about 2014, 2015, the corporate VCs only. So this is something that you have to keep in mind when you look at corporate VC data. So the numbers have gone up 3.7 times, but the dollars in which the corporate VCs participated in was 9 to 10 times in the same time frame. So there's a lot of strategic money that actually went in. So the dollars that I mentioned are not the dollars only that the corporates put in, but in the big deals and the rounds that they invested along with VCs and even along with other corporate VCs. So you look at the percentage growth in each of those areas in the last few years. It's just mind-boggling. The largest deal makers in terms of number of deals, you can see Google Ventures, Salesforce, Intel, they're still the dinosaurs. But suddenly you had Baidu, you have Legend, you have SBI from Japan with multiple entities around the world. You suddenly have the Asians kicking in like crazy. Take pictures, as many as you want, because this is still a pre-release of some of the material which is not going to be shared. But so take pictures if you like. Then looking at the new corporate venture teams, CVC teams being established, look at this. This is about one a week is being established around the world. So corporate venturing now is reaching more and more developing and even emerging markets where they go in. What does this show? This shows US, Europe, APAC, and then some countries here in Asia, and even comparing with Israel. It looks at the bottom, the brownish golden color is the only foreigners that invest into deals as a percentage in the country. The green one is a hybrid of domestic with a foreigner, and the blue one is only domestic. So in Asia, you can see that it varies. Entire Asia, APAC, is 41%. In China, it's 25%, which are only foreigners. I can tell you 10 years ago, this was almost 80% of all the corporates were foreigners. Now the local Chinese have picked up. And I see this, keep this in mind, in every new market. Very often it's foreign corporates going in, investing with local VCs, and then a few years later you see the rise of domestic corporates. And initially, the domestic corporates don't co-invest along with each other in the domestic market. And another 3, 4, 5 years later, suddenly you see domestic corporates going in. In China, it was suddenly, you didn't see deals with Baidu, Alibaba, Tencent for a long time. But at some point, it started kicking in. Some went earlier stages, some went later stages, and some of them invest even into the same round nowadays. Look at APAC. I look at corporate VC inflow into Asia Pacific. 226 deals alone in Asia. And where do the deal numbers come from? From North America. So it's almost 2/3. that go into, that come from North America going into APAC deals. I have a breakdown on every major country, from to China to India, but this is just the aggregate. When you look at Europe, is now at 35%. So that's roughly, as you can see, the US loves Asia and likes to access. So why do they invest in? 2 reasons. Corporates. When it goes to Asia, it's mainly access to the market. If it's in other parts of the world, they invest in Israel, in Europe, and somewhere else. Even the Asians go overseas. It's mostly 2 things: access to technology and access to markets. And when it comes to performance, I don't have the time to go into too many details today. I have some performance coming up later, but I can tell you is the highest returns you get, and this is the takeaway, keep this in mind, the highest returns that you can get is, and it is matching, it's a piece I have not published yet, but I have finished the research, is when you have a acquisition done into a portfolio company done by a foreign corporate. It reaches almost identical, the IRRs or the exit multiples particularly, compared with an IPO. And it's dramatic. It's almost twice as high. Why? Why a foreign corporate? Because a foreign corporate is interested in market access. The local guy is already in the market, the local corporate. And he wants to buy the technology. So that's why I said, if the corporates can, if you hit both, so if you're a GP, and I'm urging you, you want to maximize your returns when you know your company is going to be acquired, make sure you don't only go to the local corporates, bring in, for competitive reasons, a foreign corporate. And guess what? You can almost double your returns on that one. I've done the math on hundreds. I looked at 5,500 deals, of which 3,500 were acquisitions. Now, that was the result of it. Okay, happy to share that with you. Then you have Asia outflow. So where does APAC invest in? Again, it's a similar number. 3/4 go, in terms of number of deals, go to North America. 14% to Europe, and a little bit to the Middle East. Middle East is almost 95% just Israel. They're just after technology nowadays. If Asians invest in the Middle East, it's mainly access to Israel. Then, this is very quick. I gave you a high-level summary. Corporate startups acquired by geography. So US startups, if you look as a percentage, get acquired in blue means they get acquired by the Americans. And it's typically in the range of 75 to 80%. Just the colors will tell you. The arrows will tell you. Western Europeans, yes, they get acquired also mostly by Europeans. But last year is it a turning point or not? I can tell you. Watch the trend. Europe sits on great technology, which is at half the price or even better, right? US is too competitive. We'll come back and talk about this later. But they get acquired now a lot more by Americans looking at European technology, which is equally as good as the US. Look at China. It's almost, most of it acquired by domestic corporates, and now more and more Americans going in for the market access. India, there are not that many deals, but it's still kind of a local play, and then the Americans kicking in. And if you look at Israel, it's mostly US, the large bulk US, but I predict more and more Asians going to acquire startups also from Israel. This is a quick one. This looks at, the question is always, startup M&As acquired by domestic versus a foreign corporate. And you look at this. The US is pretty much flat, 2/3, 3/4 acquired domestically, and then the foreigners. And the same thing, this is globally, the same thing, 80% is acquired by US corporate. Europe, interesting. Foreigners love to acquire European startups because of, as I said, because of technology and valuation. China is still mostly acquired by Chinese. We saw that in a nutshell. So this is just in a similar view by by foreigners versus local corporates acquiring. And then the last of the multiple slides here is corporates acquiring their own startups. And by the way, I give you a freebie here. This is not published yet, the result, but I show you the data up front. I always thought, in terms of performance, what does it mean? I was the one looking at performance, if a corporate is involved or not. And I was looking at corporates acquiring their own startups. And I always thought from my guts that if a corporate invests in a startup, I assumed that when they acquire a company, they know them so well they put a lot of more pressure on the price on those guys. It's not true. My research, which has not been published, but I'll share the result with you, is it doesn't matter if an existing corporate acquires or if an outside non-investor corporate acquires the company. There's not much of a big difference. The difference is it a domestic or is it a foreign corporate? That is where the big difference comes in. So as you can see, in the US, look at, there used to be less and less investors, corporate investors acquiring their own portfolio companies. It went down, but look at, suddenly 2018 picked up. Same in Europe, the same in China. And I go like, wait a minute, what is all this about? And so then when I looked at the details, even in APAC overall, it started picking up. And I go like, why is it? So I went down on the deal level. And the reason suddenly why after all these years, there has been less acquisitions, that means there have been more scouting. They're interested in what's going on. So that's why less and less got acquired. And suddenly this increase in acquiring again. The reason is a lot of industrial corporations, traditional industries, were under a big squeeze. From AI, they had no AI capability, no machine learning capability, none of these very modern technologies in-house. And in order to beef themselves up quickly there was a lot of number of acquisitions of relatively early stage companies in, I call it the deep tech area, which includes AI, machine learning, etc. This is why suddenly you see a pickup. It's not in terms of dollars, it's getting access to those early stage technology companies to improve their own capability in new age tech, in deep tech. That was the reason why suddenly, for the first time for many years, there was a pickup in the last 1 year. Then a quick one on Asian investors. I make this very quick. I'm always looking at corporates going global, and I look particularly because Bay Area is still a hot spot. The Japanese top deal makers are NTT, Dentsu, Mitsui, Rakuten, and SoftBank in terms of number of deals. But SoftBank has different entities. You will see this in a minute come up. The Chinese, Baidu, Tencent, that was expected. But Wuxi Healthcare Ventures and Legend Capital and so on and so forth. You see the list of the Chinese quickly dropping up, but the top two, Baidu, Tencent, probably no surprise for you. And then you look at South Korea, you could expect Samsung, but SoftBank's entity for Asia actually, in SoftBank Venture Asia, which is based in Korea, also invests a lot more in Silicon Valley than the parent company. The tickets are smaller, but if the parent company invests, the group invests, it's big tickets. It's less deals, but big tickets. So this is where, just giving you a flavor, they all go there for two reasons. Access to technology, and half of them, or even more than half, access to the US market through such an investment there. So let's go and look at very quickly at dry powder fundraising in Asia. You can see in red colored, this is where Asia is. So the dry powder is steadily going up in Asia, getting close to the US. So Europe is very low on dry powder. Oh, that will have an implication later on, as you will see. The asset under management in green on the top has gone up. Asia dry powder in blue, and VC unrealized is in red. And this is what you saw from Cambridge Associates. There's a lot of unrealized capital and deals still here in Asia. You look at fundraising. Currently, as of June 2019, In terms of number of funds, it's mind-boggling venture here. Compare in China vis-a-vis ASEAN, North Asia, and South Asia. So these are the number of funds, and also in terms of absolute dollars, China just dominates about 3/4 in terms of numbers, and in terms of dollars that are being raised. But as indicated by the speaker from Cambridge Associate, there is a massive drawback, a decline in number of funds closed and particularly the number of dollars raised now. And you see my little projection on the right-hand side into the first half. I just doubled up. And even if it doubles in the second half of 2019, it will be a massive decline. Why? What does that mean? Would that mean a lot less deal? I don't think so. Simply because Asia sits on so much dry powder, which they first need to invest. So LPs have become a bit more cautious of supporting new funds. And there are less funds fundraising too, by the way, simply because they have just raised the last 2-3 years enormous amounts of capital, as we could see before that. So they're still sitting on that dry powder, which has not been deployed. Most active countries in fundraising, if you look at 2011 to 2019, China, and this is in proportion, by the way. You see, China, as we have seen earlier, is the big bulk of it. There are, even in US, funds in the US that focus just on Asia. There's a portion of it. So you can say 89-90% goes to China, South Korea, and Japan on terms of number of funds closed over those years. And you look at, in terms of capital raised, it's China, US, and South Korea that have been closed with a focus on investing in Asia. And then lastly, in terms of fundraising, this is the latest Preqin LP survey looking at 2019, this half year, into the next 12 months, where they're planning to do new investments in funds. Vis-a-vis, and you see the difference now, North Americans still focus and are planning to focus on investing. 96% of the respondents said, we will keep focusing on the US as US investor. That just came slightly up. Asia has also been on the rise, which is in, Europe has been on the rise in red and Asia in green. So overall, LPs are interested in increasing, US LPs are increasing in all three geographies. You look at Europe, Europe is slightly decreasing the US allocation, is increasing the European allocation because they realize you can suddenly make actually good money on Europe. I'll come back to this. And they're also increasing Asia, while Asians are decreasing the US allocation, they're decreasing the European allocation. Understandably, they're focusing on the markets they know well, so there's an increase, and 94% of the respondents said of Asia investors will focus on 94% of the respondents that will focus on Asia, which again is an increase. So where does the money go? This is quick. Third, Asia was on a massive rise, and it's on a decline as a percentage of all deals in dollars invested, and that's due mainly to China. China has been driving the rise, and because there's been less investing in China the first half of this year, the reason you can see the decline of the Asia proportion against North America, against Europe. Europe relatively flat, so it's a play between Asia and the US that goes up and down. You look at terms of number of deals, about half of it to 3/4 over the last few years that's China deals. We saw this, but in terms of dollars allocated, it's about 2/3 to 4/5, which go into Asia, into China the last few years. And you can see the balance. India has been picking up, the rest gradually, but the amounts in other portions, the actual dollar amounts or number of deals are relatively small still to China. How does this is global number of deals, the global dollars invested around the world of VC, and I deliberately put Asia into perspective on the same slide. Now you can see the rise also of Asia, and suddenly now the decline into the first half year of this year. But still, it is a significant portion. Don't get this wrong. Look at Asia versus Greater China, of which the large bulk again is China. China, Greater Asia, within Asia, we have seen this, and you see it here again confirmed, year over year is still amazing and is still significant. Now, ASEAN. When you look at ASEAN in all the countries, the large one, which you've seen here, is the purple one in Singapore. And then you see Indonesia in green. So these are the two major countries when it comes to the rest is marginal. It doesn't mean it's bad or whatever. They are emerging. They're at the beginning what China was for me when I came to China 15, 16 years ago, looking at the venture space. It's all emerging here. So interestingly, Southeast Asia was 6% last year of entire Asia. In the first half year, it's suddenly 10%. So I see an increase. So China coming down, the other parts of Asia, of Southeast Asia moving up, and so it makes now a 10% proportion. Another quick view on a global benchmark analysis. You see China and Europe in the green box relatively flat between 2010 and 2013. Then you see the rise on the dark brown one of China going huge, big. It's only the US which you can see, which has been topping China. So China very clear worldwide by any dimension in terms of numbers of dollars involved. That's where it is. So they're reaching almost the 100 billion mark. It was over 90 billion in China. And I don't think it will exceed this year because it's been a slowdown in the first half of 2019. Now talking about super scalars. These are companies that have received $1 billion in funding. I'm not talking unicorns valuations. I say $1 billion in funding. 11 of them were in Europe. 38 in China. 38 in China. And the US topped 66. So it's almost 200 billion versus 100 billion versus 25 billion. So it's pretty much linear almost. So Europe, relatively small. They have a large number of deals, but they don't scale as large as the Chinese do, right? So this is the summary of the 38, 60, and 11 deals. So 184 in total between 2010 and 2018. Now a quick backdrop, very quick one. This is my latest analysis on deep tech investing in China. I just wanted to share with you. Look at the rise of the dramatic rise of 129 or almost 130% in terms of dollars or RMBs invested in China in AI. Similar, you have a 40% year over year over those years in biotech and healthcare in China. And you have an amazing high-end equipment manufacturing, which includes robotics, which includes factory automation. The Chinese are mind-boggling on this. So that is significant. When it comes to electronics and semiconductors, it's still at a very high level, but the big growth, this has been traditionally quite high in China. But so there is no steep curve like this, but it remains on a very high level. 2017 was an exception with a single deal by Tsinghua Unigroup, Tsinghua Unigroup, which would go beyond the scale. So I took this out for this reason. But anyway, you can see there's almost no other place in the world where the growth rate has been that dramatic over the last few years. Talking about exits. Silicon Valley exits in those years, in the last few years, still being number 1, New York 2, London 3, Los Angeles 4, Beijing 5, and you see roughly, so here is where the other deals come in terms of the tech hubs and their strength. So let's look at something interesting I found. I looked at Europe, US, China, and Israel. And on the left-hand side on each one, you see the money that went into the average capital raised pre-IPO and then the one at IPO or post-IPO or IPO versus IPO. And you can see that in Europe, there was a 55 million to 138 million. That means there is not enough capital of VC in Europe. Trust me, I'm a European. I look at this for the last 20 years, right? So Europe, in my view, is one of the places underfunded. That means what? This is an opportunity also for Asian investors, and particularly corporate investors too. And so they need to have the IPOs and post-IPO money to scale the companies. Particularly growth capital is missing. In a very early stage, Europe has enough money. But when it comes to really growth and late stage, there's a lack of it in Europe. So I'm saying China and US are still flooded with money. Later stage lacks in Europe. So, and if you look at the superscaler who received $100 million plus, amazingly, 70% of the Europeans are public because there was no money available early. So they went earlier to the market to raise enough capital to grow a superscaler. So that's where they raised the capital from. And in US and in China, it's about a quarter. So that means what? There is enough money around to scale them up with venture money before they go public. That is the difference between US Asia vis-a-vis Europe. I wanted you to understand this. Here are the tech scale-up IPOs by region, and there's always these massive outliers, as we have seen by Cambridge Associates. So over the last few years, you had Facebook in 2012, you had Spotify, which is actually a Swedish company, went public in the US because there's not enough depth of the capital market in Europe. You look at Europe, the ones that exited in Europe, which are mainly then the Europeans, same thing. You have 2-3 outliers within Europe, and this is at scale. Look at the size of the scale of the market, and this alone is China, right? And we saw that Xiaomi and 2-3 others in 2018 just blew the entire market here, right? So look at global versus Asia VC financed exits. So if this is global exits, this is Asia, in contrast. And it's still relatively small of exit finance in Asia. And as was mentioned by Cambridge Associates, is that many of the big Chinese ones went public in the US, so they don't show up under Asia, right? So this is where the capital was raised. So let's look at, again, in high quick, North America is blue, red is in Europe, and green is in Asia. You have some outliers. Flipkart, which was a massive deal, like I call it the eBay of India getting acquired by Walmart. That Alibaba was another one when it comes to the exit proportion by region that skew Asia, but you can see it is still dominated, the actual aggregated exit value, by the United States, by any dimension. And then within Asia, if you look at Asia, it's interesting. About half of the number of deals are trade sales. And about 1/3 in the last 4 years, about 1/3 to about half, in fact, are IPOs. So this is in terms of number of deals. When it comes to the dollars, if you look at the dollars, about 1/3 in the last 4 years would be roughly M&As in terms of aggregated value, dollars on exit. And IPOs, especially in the last 3 years, would be anywhere from 60 to 75% roughly in terms of IPOs. So IPOs are really critical of getting the value done here in Asia. And then you look at the proportion of number of deals as a percentages. This is how it goes. Oh, sorry, that was a bit too fast. Oops. Okay. Here is the percent. So IPOs in Asia are absolutely critical, and it's much higher than in the other parts of the world. So how about performance? Asia VCs are outperforming private equity and all private asset classes. We have seen this, but these are now the numbers which are PRECME data, which are almost equivalent to actually the Cambridge Associates data. So red dotted one is VC vis-a-vis private capital and private equity, which are significantly lower. The top quartile, the medium, and the bottom quartile here of VC funds in Asia, focusing on Asia, is mind-boggling. And I'm telling you what, the next slide will show you that Asia median VC net IRR has outperformed all other VC funds from, if I pull them, the other ones, rest of the world. This is why so much money in the last few years actually came into Asia and was, as we heard, mainly driven by China, but now you have seen a shift. So I'm wrapping up with internationalization of startups. Here a quick insight. And of the top 50 most active US tech investors, 1 out of 4 deals is now outside the United States. Outside the US, 15 years ago, unheard of, 10 years ago, unheard of. But recently, the Americans go where the best deals are. And you can see that of the $100 million tech rounds, you can see there's at least 50% in all these deals is an American VC in, around the world as a median. So this is pretty stunning when you see this. When you look at where American startups go, when they internationalize, it's predominantly Europe, a little bit to Asia. You look at Europeans still going significantly to the US, very little actually coming to Asia. Israeli have no other choice. They go to the US, they go to Europe. They go increasingly now to Asia. And then the key is, as a VC investor, let me tell you the following, or as an LP, here is what you need to understand. When it comes to internationalization, and I give you here the pictures, same picture as before, but just as only the focus of where do they go to the United States. Pretty much in a nutshell, about 1/3 goes to Silicon Valley. A bit more goes into the B&B space, business-to-business space, to Silicon Valley. Life sciences more to Boston, and then you have fintech and others going to New York or the San Diego area, and then the rest is not that much either. So from almost every location, about 1/3 goes at least to Silicon Valley, which is still the main hub in that sense. But the answer is, when do they go to Silicon Valley? As I mentioned, it's 70 to 90% go in revenue pre-profit. And if you want to create a top 3 sector leader, here is how it goes. A top 3 sector leader, when they come from outside the US, become a US top 3 sector leader, is as soon as you hit local market validation in your own market, don't flip the whole company any longer to the US. That's history. That's actually, some VCs in US are still that way, but the new generation and the top VCs are shifting now. You set up another office in the US, especially at the beginning. Don't flip the company, even if the US may become the largest market. Then you enter that market not with a massive round, with a smaller round to test market validation in the US. That's what I recommend you to do. And if you do this, you can do this as a pre-Series A, actually, because the seed funds, 86% invest domestically into the next round from seed fund is a Series A, 96%. Another 80% a local Series B. If there is a US VC in, there's a 43% chance this company may end up with an office also in the US. If not, it's a Series C. What does that mean? If you have a world cutting-edge company from Singapore, from India, from China, from somewhere else, at the moment they hit the local market, they may have the very best solution. But because the seed fund managers only have access to the local Series A guys, it hands it over to Series A. There will be a local Series B, another 80%. That means what? When they go to a Series B or Series C to Silicon Valley, it's 2.1 to 3.7 years too late to Silicon Valley. And it will never, ever be a top 3 sector leader. So internationalization has to be early, after local market validation, do an expansion to the US, and basically, that's where you get the highest performance. And I don't have to slide. My last word to this is, when you have corporates in, I looked at the performance of Series A investors. Series A investors can make as much money. Remember what I said at the beginning? As much money in a local acquisition, in an acquisition by a foreign corporate, as if the same company has an IPO for a Series A investor. That's a very important message. I don't have time to go into this, but hopefully maybe next year. That's something I'm releasing officially then. So that's it. I will wrap this up, and my time is up. So catch me. Today I'm busy on stage to chair the session. I'm here for the next 2 days or 3 days. So catch me for any other question. And let's go out, take a break, and network outside. I'm a few minutes late, but I'm just so thrilled. I can't stop taking out more slides. Okay, there we go. Thank you very much.